Starting now, you can get a transcript of each week's Rich Dad radio show. Just visit www.richdad.com/radio and download a copy today.
This is the Rich Dad Radio Show, the good news and bad news about money. Here's Robert Kiyosaki.
Hello. Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. So we have a very important show to you today. It's one of the most important shows anybody, I don't care if you're rich, poor, or whatever, you've got to listen to this program because it's about your number one expense in life. We're talking about the new Tax Reform Act that was passed by President Trump. Now, I know some of you are saying, well, what difference does that make? Because I live in Europe or I live in Asia and all this. But taxes affect everybody. And these tax laws, because America is still a relatively rich country, will affect you too. And I just want to be aware, everybody be aware of this, is that if you've read anything from Rich Dad, you know the tax laws favor the rich. So if you have any communist or socialist bones in your body, this would be a very good program for you to listen to. Because if your mommy and daddy told you to go to school and get a job, you're going to find out mommy and daddy misguided you. Because if you have a job and you're an employee, you're going to get screwed even more while this new tax changes favor the rich. And I mean the rich. So it's a very important program. I don't care where you live throughout the world. This program and our new President Trump, I know some of you love him, some of you hate him. But the rich love him right now because he has structurally changed the tax laws for the rich, but he's not structurally changed the tax laws for those of you who work for money. So this is a very important program because taxes are your number one expense. And you're going to find out why people like myself make a lot more money and pay almost nothing in taxes legally. Very important program. Your number one expense, taxes, regardless where you live in the world. I know some of you are probably cheating the government, but you don't have to do that because you're going to find out the government and the tax laws really favor the rich, but they don't favor crooks. So if you're skimming the government, please, this is not your program. You've got to get honest to do this. So our guest today, our Rich Dad advisor, Tom Wheelwright. And this is a man who makes me more money than anybody else I know because he lets me keep my money. You know, so many people say, oh, I made so much money. And I go, well, how much you pay in taxes? And then they don't want to talk about it. See, people focus on the gross, not the net. So Tom Wheelwright is the author of Tax-Free Wealth. The second edition will be out soon to adjust for these new tax changes. And our second guest is Ed McCaffery. He's a favorite of this program because these guys are really smart guys. They're A students, and I was a C student. And Ed's an expert on tax law, election and voting reform, and estate taxes especially. So look, if you're going to be rich, you've got to have estate planning while you still got time. Because if you don't do estate planning when you're alive, the tax man's going to get your money anyway. That's really silly. None of your family's going to get it. So Ed is Executive Director, Institute on Federal Taxation. He's a director. He's at USC Caltech Center for the Study of Law and Politics. So welcome to the program, Tom and Ed.
Hey, great to be here, Robert.
Yeah, great to be here, Robert. Great to be here with you too, Tom.
So we're going to do our best because you guys are the smart guys, and I've been reading this paper, and it's the update on the conference committee tax bill. And I read it last night, and I slept very well because I fell asleep immediately. It's the most boring stuff.
It'll do that for you.
It's the most boring stuff I've ever read. I don't know how you guys do this.
You're also rich, so that would help you sleep well.
Yeah, no, that's. I was worried about people coming after the money. Get my attorney on the program. But anyway, we're going to talk about the tax law. So, Tom, what is your opinion of President Trump's tax law? This is a big change from '86, right? This is the first time since 1986.
It's the first major change to the tax law since 1986, and it very much restructures the law as to who it favors. So corporations, entrepreneurs, and real estate investors are the really, really big winners.
That is fantastic news. And then, Ed, so what is your opinion
I would say three take-homes. Number one, which should be familiar to your listeners, Robert, and your readers over the year, don't be a wage slave. This is another step in a continuation of a theme where the income tax is really becoming a wage tax in drag. If you depend on a W-2, if you're an employee, as Robert said, if your mom and dad told you to work hard and get a good job, not necessarily good tax advice, and this law isn't going to help you all that much. We're losing deductions, and the deductions we still have are at risk of being lost altogether. So number one, stop just being a wage slave. Stop being a simple employee. Number two, if you do have a small business, if you have a business, any kind of business, you're a sole proprietor, you have a partnership, you have a C Corp, an S Corp, go to somebody like Tom. Go see an accountant. They're complex rules, but there are lots of goodies on this Christmas tree. And even though you're not going to be paying taxes under this law until April 15th of next year, get to an accountant early to think if you can restructure the way you do business, because there are goodies on the business side. And the third point is on the estate planning side, I think we've opened up the golden age of dynasty planning.
Amen.
This is very favorable law for whatever listeners in any jurisdiction who have wealth. If you have wealth now and you're intending or desiring to pass that wealth on to your families, book it up. Book it up forever, so that the government's never going to get that tax. And again, back to that first point, don't be a wage slave. Well, help your kids, help your grandkids to have a hedge against the wage slavery by booking up a dynasty trust. You know, again, if you have the assets to do that, if you're going to give wealth to your posterity anyway, get thee to an estate planner and start thinking of setting up a dynasty trust. So 3 points. Don't keep earning wages. Go to an accountant if you have a business or thinking of starting a business. And if you're wealthy enough, get thee to an estate planner.
Well, and in fact, never before have we had such an interesting use of the estate planning combined with the income tax planning, where you have an estate planner, you have an income tax planner, you have an attorney, so you have attorney, an accountant, and you have that team together. And it doesn't matter where you are in the world, you're going to have, you put those together, you're going to get the benefits from whatever laws, whatever incentives your country has and are available to you.
Right. I mean, Ed McCaffery just talked about my new favorite word. It's called dynasty. I've heard the word, but it had no meaning for me as the word dynasty. And the average person is not going to leave jack for their kids. The government's going to get it all. They're going to, even if they have something, they're going to die, and it's going to be taken away. And so what I understand from this tax law from President Trump, because he's a rich guy, obviously, he's saying that this is the time to pass it on to your kids and your family for posterity. Now, if you don't operate within this window, and let's say, I'm not Republican or Democrat, but let's say somebody like Hillary gets elected or Obama gets elected or Bernie Sanders gets elected, the window might close. So this is the time. If you have kids and you have a lot of money and all this, now's the time to put it in that little box and pass it into the future before one of the socialist communists get their hands on your dynasty's wealth.
Right, because a lot of these provisions expire at the end of 2025. And so doing it now, we've got a few years here to be planning. You're going to be set for life.
My friends who are rich, their kids are rich now. And their kids are going to be rich forever. And that's what a
if I could just jump in with a couple of points. One, what Tom just said is these laws are set to expire in 2025. Don't wait. Don't wait. 2025 is a long way away, and what Congress did, Congress can undo it. 2025 would be after a re-election of President Trump in 2020. And whatever you think of Trump, you've got to think that's not a set thing. That's not a done deal. So Oprah may be coming, Bernie may be coming, the Democrats may be coming, and this law can get undone much more quickly than 2025. A second point, and I think Robert is right to be talking about the rich getting richer, and
dynasty,
you talk about
dynasty.
something. You talk about something like Dynasty, and you think we're talking about the billionaires, of whom there are many. I don't know if they're listening to the show, but God bless them if they are.
There's
But I think that idea,
Ed, there's 600 billionaires in America. I want to be one of them.
And the number's growing, and you will be. You keep listening to the show, you keep running the show.
All right.
But let me say something about that. Suppose that you're just a younger person, you're in your 40s, and you have one of those jobs that Robert and I and Tom are telling you maybe you should think about not having, because just having that wage, those wages mean you're taxed. And you don't really have much savings yet, but you go out and you get a life insurance policy, which is a good thing to do because you have young kids. And if something were to happen to you, you would want that insurance policy. Well, guess what? That insurance policy should be in a dynasty trust. When something happens to you and you die and that policy kicks out a couple of $1 million, that's a couple of $1 million that the government's going to be able to see and maybe tax unless you've taken the steps to lock it up and get it out. So
let me ask you this. What happens if it's not locked up in a dynasty trust and I have $1 million policy, I die, what happens? How does the government get the money?
You're just exposed.
You could be taxed on it.
Yeah, I mean, you can be taxed on it. They can do anything they want. I mean, the reality is, unless you protect yourself and set it up so that you can control it, okay, which is what a trust is about, is you being able to control it, then the government can get at it. One way or another, they can do it.
Once again, it's Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And we're talking today about the tax plan or tax planning, but more specifically, the Trump tax law change, why it's giving us a window at this moment for the rich. Now, and I've been saying this for years, the worst advice is go to school, get a job, work hard, save money, buy a house because it's an asset, get out of debt, and put it in a 401k or an IRA. And that's what everybody's told, and that's what the mass majority of people are doing. But this new tax change from the 86 Tax Reform Act, which Tom was a part of, is really written for the rich. And I want people to listen to this program. I don't care where you are in the world, because the tax laws are virtually the same for the rich. Structurally, the laws are written to favor the rich and punish the working class. It always has been and always will be. But we have a window right now. So when we come back, we'll be going into, I know some of you listen, well, I don't have any money. I have a job and all this. My mom and dad lied to me, and how do I get out of this trap? We're going to go into that, because it's really, because look, if you don't change, you're just going to pay taxes all your life.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Log on to richdadradio.com while you listen. Now back to Robert Kiyosaki.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. The lesson today is President Trump has just created this Tax Reform Act. And all of you, I don't care where you are in the world, the tax laws are written for the rich. And if you went to school and mommy and daddy told you to get a job, save money, and work hard and put your money in a retirement plan, they lied to you. I mean, they really did you a disservice. So once again, you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android. And all of our programs are archived at richdadradio.com. We archive them for a number of reasons. One is repetition is how you learn best. You listen to this program again, you may have the lights go on. But most important, if you have friends, family, or business partners who believe in paying taxes, have them listen to this program, because I'm not kidding you. I get so much pushback when I say that I make millions and pay almost nothing in taxes. I mean, people, their hair on their backs stands up. They hit me with their umbrellas or their purses. You're a crook and all this stuff. I said, look, the tax laws are written for the rich. Get the message. And if you went to school to get a job, you're the one who's being lied to. And I'm just the messenger. So we have two guests today. Tom Wheelwright, Rich Dad Advisor on Tax-Free Wealth. And this guy's made me more money than anybody else because I don't have to pay taxes. I mean, I pay less and less taxes every year because the tax laws are written for the rich and for those with the ability to afford professional tax advice. And our other guest is Ed McCaffery. He's expert on tax law, election and voting reform, estate taxes. We're talking about dynasty wealth. And most people say, well, I can't even pass anything on to my kids. Well, the rich are passing on to their kids for perpetuity, means they'll be rich forever. He's the Executive Director, Institute on Federal Taxation, Director at USC Caltech, Center for the Study of Law and Politics. So let's start with Tom. Tom, you were involved in the 86 Tax Reform Act, and this is a big tax reform under President Trump. But can you give us a little your background on how you got involved in this?
Yeah, sure. So I have a master's degree from University of Texas in tax. And I spent 3 years during the last big act, 1985, 86, 87, and I was in the National Tax Office of Ernst & Young. And then I've devoted really my entire life to studying the tax law and created a firm 25 years ago. And Robert, you and I, we travel around the world talking about taxes. And, one of I think...
and people squirm when we talk, don't they?
They do.
They're so afraid of the tax man.
They're scared to death. And that's the point I want to make, is that people forget this. The fundamental principle of taxes is that the tax law in your country is a series of incentives. It's incentives primarily for entrepreneurs and investors.
Yeah, and they're not loopholes.
No, they are not loopholes. These are intentional.
Incentives.
This tax law that was passed in December was not unintentional. It was an intentional tax law, and they were intentional changes. The corporate rate was intentionally reduced to 21%. The tax rate on entrepreneurs was intentionally reduced by 20, 30, 40%. The taxes on people who buy equipment and buy new cars and have a home office. These things were all intentional. They're intentional in the law. So Congress wants investors, professional investors, and they want entrepreneurs, and they want to reward them because they know that that's what creates jobs, that's what creates housing, that's what creates a better economy, and that's what this tax law really was all about.
Yeah, let's give you your tax money back to you, but you've got to make some changes, right?
You do. You have to make some fundamental changes in how you look at your money and how you make your money. If you're making your money as an employee, like Ed and Robert have said, if you're making money as an employee, this tax law probably hurt you. Actually, where the funds came from, where the money came from to pay for the tax benefits for the entrepreneurs and the corporations was from the employees.
And this is what my rich dad taught me years and years ago. My poor dad always says, go to school, get a job, and work hard. And my rich dad says, don't do that. And it's always a controversy. And tax is one of the biggest subjects because most people are terrified of the tax man. I say, I just want to pay my taxes. Well, you should because you have no financial education and you're doing all the wrong things. And if you don't pay your taxes, then you are a tax evader. So that's why you've got to make the changes. The government's not going to change for you.
Right. Yeah. I mean, if you pay taxes the way you're supposed to, the way the government wants you, and become a partner with the government, really, and do what the government wants you to do, you get to sleep at night and pay less taxes at the same time. Legally. And
then one more thing is this. You've been all over the world with me. We travel all over the world. Basically the same, isn't it?
Every country, I always study the tax law, and the fundamental rules are the same, right? It's entrepreneurs, it's professional investors that are going to get the tax breaks. The way you get rich faster is the way you pay taxes slower. I mean, that's the way it goes.
And Ed McCaffery, I'd love to have you on the program. Every time you talk, you disturb a lot of people out there. And once again, what does being the director of USC Caltech Center for the Study of Law and Politics, what do you guys do there?
Well, we do a lot of kind of academic stuff, Robert, and that's the point I want to make, that I love being on your show. I love reading your books, and I'm always happy to do it because you learn some of these lessons, as you repeatedly remind your listeners and your readers. You learned them when you were a kid from your own dad and from people you were growing up with. I went to Harvard Law School, and I started to figure out at Harvard Law School what was going on. And one of the things I realized now, then and there, was that the fancy academic people, the elite people, they don't speak English. So I was able to look at the tax laws as Tom has, and I was able to look at the advice, Robert, that you were given as a youth, your rule number one from your initial book, Rich Dad, Poor Dad, buy assets. And I was able to reduce what you and Tom are talking about, this sense that the tax laws really everywhere in the world favor the rich, to 3 words. It's what I call Tax Planning 101, buy, borrow, die. And that first step buy is that you buy assets, you buy real estate, you buy stock, you buy index funds, assets that go up in value without producing cash, assets that rise in value without producing cash. That's the key to not paying tax on your growing wealth. And then if you need money for whatever reason, you borrow. And borrowing, which a lot of people, again, you're taught, Robert, when you talk about the advice you're given, it's being bad advice. Among that bad advice is never, ever borrow. Don't borrow recklessly, but borrow prudently, and that's a very tax-favored strategy. And then if you buy and you borrow, when you die, you get something that, Robert, I know is a favorite topic of yours, and I know Tom knows about this. You get the stepped-up basis on death, and the income tax responsibility for your asset goes away. So buy, borrow, die, not what they taught you at Harvard Law School, but the kind of advice you can get from listening to and reading Rich Dad, Poor Dad.
Well, thank you for the endorsement there. There's one little caveat or correction, is I make a lot of cash flow. I make more cash flow or passive income. And I don't have ordinary income. I have passive income. And I don't have portfolio income. I have passive income, right, Tom?
Well, right, because the nice thing about what you do is when you borrow to invest, the government gives you more deductions, and so you can have cash flow and still not pay any tax.
Plus, I depreciate the asset.
Well, that's the point.
Which is why I stay out of paper assets, because I don't get much depreciation from
an
ETF.
You don't get many tax benefits from an ETF.
Yeah, so we're real estate guys, hardcore here. So, quick question: what does stepped up mean, Tom?
So step up means you get depreciation, right, over the years. Which
right, so let's say I have $55 million in real estate.
Okay, let's say you paid $55 million for it, and over the years you've taken deductions for that, and now your basis, okay, so that's what you paid for minus your depreciation is only $20 million. Okay, when you die, guess what? All of that tax between 20 and 55 goes away. You step up your basis back up to whatever the value is. So now your value could be $100 million. Your basis is stepped up to $100 million. You never pay income tax on that. Never pay capital gains.
What do you have to say about that, Ed?
I say that's good. And I think, the fancier words that you and Tom are using as you talk about real estate, things like depreciation and cash flow and passive, that's all exactly right. That's all. You guys know what you're talking about. But it still comes down to buy, borrow, die if people want a simpler thing. So you can buy real estate and take and yes, Robert has cash flow, but Robert also has deductions. And those deductions come from owning the asset. Just like Tom said, you own an asset, not yourself. That's the problem with the wage slave. The wage slave only owns his or her earning capacity, and that's taxed. If you own real estate, if you own stocks, if you own an asset, a business that's rising in value, that's not being taxed. So that's still step one. And then step two, borrowing, prudent borrowing. Borrowing is part of your financial strategy. And then you get to rejoice at the death because, as Tom just explained, the current tax laws, even though almost no one pays an estate tax, every person in America, and these are parallel systems around the world, every person in America sees that income tax gain that's built into the assets, the tax you have not been paying on those assets as they've gone up in value and you have not sold them well, you can sell them, someone can sell them after you die, and that's tax-free.
So we're going to come back. We're going to be talking more about what can you do. You see, the hardest thing is to let go of that idea of go to school, get a job, work hard, get out of debt, pay taxes, die, and pay more taxes. If that sounds good to you, well, then you should just go to school and advise kids to do that. Because when I was a kid, that's what I was told to do. And I kept saying, that doesn't make sense to me. And my rich dad and people like Tom really clarified it for me, because a lot of people were saying to me what I was doing was illegal. And they wanted me to have a 401k and a job and a house in the suburbs. And I goes, that doesn't make sense. I don't know why it didn't make sense to me. And I had to change the way. I didn't have to change much, because I was already doing real estate. I was already an entrepreneur. But everybody else thought I was nuts when I was in Hawaii. And now I don't know how many hundreds of millions I have in real estate that I can depreciate. I buy real estate for depreciation and income, right, Tom?
Absolutely.
And I use debt.
Right. And when you do that, when you use the debt, you get cash flow.
No tax.
No tax.
And I can pass it on through my dynasty. When we come back, we're going to more. Most important thing, please listen to this program again, because you've got to change your thinking. If you have a job and you're saving money, you're in trouble.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Robert Kiyosaki's Rich Dad Advisors have a great gift for you. Visit richdadadvisors.com and receive 5 free reports on business and investing success. 5 free reports that can help you right now. And while there, check out the Author's Choice audio series. Audio is a great way to learn. And for as little as 99 cents, you can download key chapters from all the Rich Dad Advisor books. You can listen to The Myths and Magic of Real Estate Investing, 7 Steps to Limited Liability, The 4 Pillars of Investing, Team Code of Honor, or The Psychology of Debt, among other great audios. For pennies, you can power up your skills for getting out of the rat race. So please visit richdadadvisors.com for your 5 free reports and your powerful and affordable audio chapters. That's richdadadvisors.com for great information that can help you right now.
This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news. Today's program on taxes, because taxes are your single largest expense. Even when you die, they're going to take it from you if you don't have planning. So go to the Rich Dad program anytime, anywhere on iTunes or Android, and all of our programs are archived at richdadradio.com, because repetition is one of the best ways to learn. But another great way to learn is have your friends, family, and business partners listen to this program, because most people went to school, got a job, getting out of debt, they're saving money, and they're terrified of not paying taxes. So what they do is they cheat. I don't recommend anybody cheat on your taxes, because that's criminal. It makes you a criminal. And I always find it interesting when I go to a retailer, say, don't use your credit card. We'll give you a discount if you pay cash. And they're stuffing it in their pocket. They're criminals. And oh no, I'm just no, you're a crook. I pay my taxes, right, Tom?
Absolutely.
Yeah. And why do you have to be a criminal? That's the whole point of this program here. And President Trump just changed the tax law. It's the first change from 1986. And the thing about 1986, it really screwed guys who had real estate. The 86 Tax Reform Act. I had to change a lot of my strategy because I like real estate. And I had to become a professional real estate investor. Otherwise, a lot of doctors and lawyers were using real estate as a dodge. And the 86 Tax Reform Act shut them down, right, Tom?
That's exactly right.
And this Trump's tax law brings it back.
Well, Trump's tax law for the professional investor. You
Right.
still have to be the professional investor. But if you're the professional investor, oh my heavens, the tax benefit
For real estate.
the tax benefits are unbelievable in this new tax law.
So Ed is the Executive Director, Institute on Federal Taxation, and Tom is the author of Tax-Free Wealth, second edition coming out. And he's a Rich Dad advisor on taxes. And I say I make more money on Tom because I don't pay taxes legally. So we need to get into how a person makes changes, okay? So, Ed, let me ask you this question. When I say I'm saving money, what do you say to me?
Well, I say good. Congratulations. That's a number one step. And then number two,
I don't save any money, Ed. I borrow money.
Well, even if you borrow, just because you're borrowing money doesn't mean you're not saving on average. And remember this whole strategy of buy, borrow, die. We've got a president who is a very successful real estate investor and who uses debt quite well. So you can still be borrowing and saving. Your assets are going up in value and you're borrowing.
Right. I'm just being hard line on the Kiyosaki method here. Tom knows I don't save money.
Yeah, absolutely. You save money, you pay taxes.
Yeah.
That's what you do. If you invest money, you lower your taxes.
Yeah. So we're pretty hardcore.
Tricked me on the save versus invest word there. But if you're investing, good. And I think if you are investing, let's talk to people like Tom. Let's talk to estate planners. Make sure you're investing in a tax-efficient way, which really should mean no tax at all. A skilled advisor like Tom, CPAs around the country, should be able to get you out of any tax.
Yeah, let me ask you this, because look, if you're going to do what I do, which is start businesses and build and invest in real estate, the trouble with those two assets is they're not liquid. And if you make a mistake, you're stuck with them. And the beauty of investing in paper assets like stocks, bonds, and mutual funds are liquid. You can get out. So I want to just say this. If you're investing in a business, you're going to start a business, or you're going to be a professional real estate investor, take classes. Rich Dad education courses on real estate, and we have coaching on that because they're not liquid. Right, Tom?
Oh, that's right. I would say that the number one thing to learn from this new tax law is it's terrible to be an employee. That if you have a business, if you're even an independent contractor, you get tax benefits from this pass-through deduction that you don't get if you're an employee. So you can reduce your taxes by 20% just by, instead of being an employee, being an independent contractor.
What does a pass-through mean?
So pass-through simply is some type of an entity, sole proprietorship, partnership, S corporation,
LLC,
it's something where the income is taxed to you personally as opposed to taxed to the business itself. Okay, that's a pass-through. Any income that's in a business that's taxed to you personally is pass-through income, and that you get a 20% deduction now. It's just a bonus.
So Ed, what do you say about that?
That's good advice. I mean, there are lots of caveats to that. There are phase-outs, there are income limitations, blah, 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 regulations that the government says they're going to pass that they haven't passed yet. But that's absolutely right. I mean, this is an important moment, I think, for you, Robert, for Rich Dad, Poor Dad, and your listeners, because it really is kind of maybe the apex of this trend. Don't be an employee. Just what Tom was saying. There's nothing really favorable in this law, and there's some unfavorable things for employees. But there's a cornucopia of benefits for real estate investors, as you guys have both. Tom has talked about that. This is a good act for real estate investors. It's a good act for investors. It's a good act for people who are able to set up their lives so that they have an entity, they have a partnership, they have an LLC, they have an S corp.
So Ed, this is what I'm getting at here. Guys like myself and most of our advisors, we own businesses, multiple employees. We own massive amounts of real estate, but the average person probably doesn't have the wherewithal. So what would you say if a person, I'm an employee and I'd rather invest in stocks? What would you have to say for them, Tom?
Well, I'd say invest in stocks through a Roth 401k. I mean,
Can they still set up an LLC or something like this?
It's not going to help them because paper assets don't help you from a tax standpoint. They just don't help you. You can avoid the tax on the paper assets, but they're not going to help your other income.
So I'm listening to the Rich Dad radio show right now. I have a job. I have 4 kids. So I don't have any financial education. I got nothing in savings. What would you say to me?
I would say, look, you're probably making $80,000, $100,000, $120,000. You could be, instead of an employee, an independent contractor for your company and reduce your taxes by 20% right off the bat.
What do you say about that, Ed?
I think you're on an important theme, Robert, which is it's just a fact of the matter that this advice is not available for everyone. the reason the government keeps taxing wages and workers is the government needs money, and it's easy to tax wages and workers. And for a lot of people, they don't think they have a meaningful choice other than to be a wage slave. So if you're in that situation, God bless you. We can hope that the laws will change. In the meantime, I do think you have to find a way to save and invest. You have to do that for yourselves. You have to do that for your family.
Yeah, all I'm saying is if you're going to do what Rich Dad does, which is we're an entrepreneur with multiple companies. So if I'm sitting there listening to this radio show and I'm an employee, that's what I don't know. How does this tax law affect them?
Right.
What can they do?
But actually, they can start small because the business benefits apply to the small business as well as the big business. So start a business. Just start small, whether it's a multi-level marketing or a home-based business. Have a home office. A home office by itself will create hundreds, potentially thousands and thousands of dollars of deductions. Just a home office, but you have to have a business to do that.
And if I have a home office business, let's say I'm a network marketing company, can I get my new SUV?
Yeah, in fact, there's this great benefit in the new law. If you buy your new SUV and it's a full size, you can deduct 100% of that SUV to the extent you use it in business. So if you use it 100% business and you pay $60,000 for that new SUV, you get a $60,000 deduction. And even if it creates a loss, you can offset income from, let's say, your spouse's wages.
So what happens if my Rolls Royce, does it have to be a SUV?
Well, you get less. You get less if it's not an SUV or a truck, okay? But you still get $18,000 deduction first year, $16,000 the second year. So there's still significant deductions available even in a passenger car.
But if I'm an employee, can I get those deductions?
You get none of those deductions. This was really a clear tax law that said if you're an employee, in fact, there's all sorts of deductions you used to get as an employee that were like expenses of the job. Those are all gone now.
Ed, what do you have to say? I'm making $100,000 a year. I got a wife, 4 kids, and I'm a hardworking employee paying excessive amounts of taxes. How does this new tax law affect me, and what should I do?
Well, again, I'm not sure that there's all that much you can do. If you are in a situation where you can incorporate if you can leave that job and start your own company, that's not realistic for a lot of people.
No, how about a part-time job? Can they do that?
No, if you have a part-time job, what are you doing with the rest of your time? Can you take that rest of your time and make it into something? I mean, sell lemonade and try to do it for a profit.
Are you saying you have to be full-time?
No, you can be a part-time business owner and full-time employee, right, Ed?
Right.
So
correct.
that's what you do.
That's possible.
That's possible.
So if
another thing to do, really, I like what you're doing, Robert, because you're trying to pull this conversation down to nitty-gritty practical things that people with less money than maybe we're blessed to have, and that certain listeners are blessed to have.
Ed, the reason I say that is I'm reading this white paper on Trump's tax law, and they said the advantage guys like us have is we can afford guys like Tom Wheelwright. And
we also don't have to get a paycheck necessarily.
No. Wait.
One thing that everybody can do, let me just make this point. One thing that everybody can do, Robert, is something that you are always talking about, that Rich Dad Poor Dad is really about, which is teach your children better. That get your children, don't keep giving that advice to your children so that your children can start thinking
don't be an employee.
Need a financial lifestyle. Right.
Yeah.
Right.
And so understand, ladies and gentlemen, this tax law and what Tom and I have been saying for years is the tax law is written for the rich, but they're not loopholes. What are they, Tom?
They're incentives. They're purposeful incentives for business owners and investors.
To be partners with the government because the government needs people like who are entrepreneurs.
Absolutely. Even if it's a part-time entrepreneur, they need you to become a part-time entrepreneur. And you're right, Ed, teaching your kids. Actually, there's a huge new benefit in the law. This is kind of a little bonus here. Huge new benefit. If you have a business and you could pay your children up to $12,000 each and you'll get a deduction and they won't pay tax.
So there's a lot of things you can do. The point of this white paper, I don't know who wrote this, they're very smart guys, but they said it's not fair. And I said, when was it ever fair?
Right. It's not fair.
But it's got more fair for the rich, right?
Well, absolutely. It's more fair for the entrepreneur and investor. Actually, it's more fair for those willing to put their assets and their time at risk.
Right. So, Ed, in a final seconds here, what do you have to say the difference between a dynasty? What is a dynasty? What does dynasty wealth mean to you? Because I love that word now.
Dynasty trusts are trusts that can literally last forever. There is no longer necessarily what is called the rule against perpetuities, which is a really annoying thing. You can see it in movies like Body Heat, but it's an obscure legal doctrine that we've now eliminated in many American jurisdictions. So you can set up a trust in South Dakota that is there for your family potentially forever. The government will never be able to tax it, will never be able to rich it. It can be a rainy day fund for your children, your grandchildren, your great-great-grandchildren. And as we face a future that looks like more of the present, more burdens on wage earners, it's going to get worse. This theme we're talking about is going to get worse. When Bernie comes, when Oprah comes, they don't have the tools to tax the rich, so they're going to increase taxes on workers. Let's start planning to get out of that. So a dynasty trust, a trust that can last potentially forever, that's outside of the government's reach, that won't be taxed. If you can buy a life insurance policy, if you can save even a modest amount of money, think of setting up such a trust to help your kids and your posterity forever.
So you don't have to be rich to have a dynasty trust.
No, you don't.
Amen.
No, you don't. I mean, they're right.
Yes, Ed, thank you, man. That is the best. I mean, that's inspiring. You know, I really thank you for, because, as I say, most people cannot do what we do. Everybody can do something. Is that what you're saying?
And I want to thank you, and it's just an honor to be associated with you and Tom and on this show, because you're trying to educate. You're not,
we do our best.
You're not hoarding these little secrets and making yourself rich. You're trying to share the truth with the world. So God bless you both.
Well, thank you, Ed. Once again, Ed McCaffery, Director, USC Caltech Center for the Study of Law and Politics, and you're always welcome on our program. Thank you, Ed. And we come back. Tom will stick with us. We're going to the most popular part of our program. It's called Ask Robert.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Robert Kiyosaki's Rich Dad Advisors have a great gift for you. Visit richdadadvisors.com and receive 5 free reports on business and investing success. 5 free reports that can help you right now. And while there, check out the Author's Choice audio series. Audio is a great way to learn. And for as little as 99 cents, you can download key chapters from all the Rich Dad Advisor books. You can listen to The Myths and Magic of Real Estate Investing, 7 Steps to Limited Liability, The 4 Pillars of Investing, Team Code of Honor, or The Psychology of Debt, among other great audios. For pennies, you can power up your skills for getting out of the rat race. So please visit richdadadvisors.com for your 5 free reports and your powerful and affordable audio chapters. That's richdadadvisors.com for great information that can help you right now.
It pays to listen. Now back to Robert Kiyosaki and the Rich Dad Radio Show.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And once again, it's about taxes, your single largest expense. But more importantly is the bad advice people are giving, the bad tax advice. Did your mommy and daddy tell you to go to school and get a job, save money, work hard, get out of debt, and invest in a 401k? That's horrible tax advice. You know, and this new tax law from President Trump, it's just proving it. And you're sitting there in your job making $100,000 a year, working a little harder. I mean, when are you going to make some changes? Because you can't. The tax law has always been this way. It's always favored the rich. And Trump just made it more favorable for the rich. So you got to change. So once again, I want to thank Ed McCaffery, he's expert on tax law, election, and voting reform and estate taxes. His message is buy, borrow, and die. I go borrow, buy, and then don't die. Anyway, but he's fantastic. He's an expert on the subject of tax, and he says, don't be an employee. At minimum, don't be an employee. And our other guest is Tom Wheelwright. He's my advisor on taxes, and nobody's made me more money than Tom because I just don't pay taxes legally. And I know a lot of you out there are skimming the tax law. You don't have to be a criminal because the tax law is written for those who are rich. So once again, you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android, and all of our programs are archived. Just go to richdadradio.com, listen to this program again, and it might sink in. But more importantly, sit down, listen to this program with your family, your friends, and your business partner, because taxes is your single largest expense. And you can submit your questions to Ask Robert at richdadradio.com. So let's get started with Ask Robert. Melissa, what's the first question?
Our first question today comes from Titus in Appleton, Wisconsin. Favorite book, Rich Dad, Poor Dad. He says, what is Rich Dad's advice on being a W-2 employee versus a 1099 independent contractor? What is the better decision from a tax perspective?
Well, that's why I asked Tom to stay behind, because if you ask me, you'll get bad advice. So, Tom, what's the professional point of view?
Under the new tax law, clearly the better tax result is to be an independent contractor, because you get a 20% deduction off the top of your income. So if you're making $100,000, you're only going to be taxed on $80,000. That's what happens if you're an independent contractor. If you're an employee and you make $100,000, you're going to get taxed on $100,000. So you get this 20% off the top if you're an independent contractor.
So when we talk about the ES, B, and the I, what happens to the S?
So the S are getting some benefits under this new law.
All right.
That's what's really interesting, is the E's are getting hammered under the new law. But the S's are getting some benefits. Now, you're going to need to sit down with your accountant, okay, and go through the numbers.
A CPA.
Make sure you're with a CPA. Make sure that they know the tax law and understand how this works, because it's a very complex law, okay? Ed brought up that there's a lot of caveats in there, et cetera. But sit down with them, and the general rule, though, is if you're an employee making under $150,000 a year, from a tax standpoint, you're going to be better off if you set it up right to be an independent contractor.
But if you're an independent contractor, don't you also lose health benefits? And
you can. So that's where you have to work with your employer and figure out, how do I continue to get those benefits while being an independent contractor?
And no paid vacation.
No paid vacation. That's
No
right. That's the big
plans.
one. That's right. So there are other things
Your
in there.
expenses go up in certain areas.
Absolutely. So don't do it in a vacuum, for sure. I'm just saying, from a tax standpoint, it's clear, but there are other reasons that you might want to stay an employee.
Right. And the other part I always recommend is you really invest in your financial education. We have Andy Tanner who talks about stocks or paper assets. We have Ken McElroy who talks about real estate, and all of us talk about entrepreneurship. And I was just saying, I'm very happy right now that my friend Donald is getting all this done. It's because for years it was like, you don't have a job? I'm going, no, I don't want a job. You don't have a 401k? No, I don't want one. You have real estate? Oh, that's risky. You don't pay taxes? Oh, you're a criminal. And I'm not. I play by the rules. Next question, Melissa.
Our next question comes from Elijah in Washington, D.C. Favorite book, Cash Flow Quadrant. So what are the biggest differences in terms of taxation between an S Corp and an LLC?
Again, that's why I asked Tom to stick around, because you listen to me, I'm the village idiot. And that's a very important lesson. Be careful who you ask for advice from. You don't come to me for dentistry. I don't know how to use a cell phone. I don't have that stuff. So when you ask somebody, please ask a professional, such as Tom, when it comes to accounting and taxes, and especially the law. What do you think, Tom?
Well, it's very important to understand that an LLC, or limited liability company, is not a tax entity. It's a legal
asset protection.
It's a legal entity. It's for asset protection. This is what Garrett Sutton, our advisor on legal, always talks about, is using an LLC. An LLC can be whatever you want it to be. It can be a partnership. It can be a sole proprietorship. It can be an S corporation. An LLC can even be a C corporation. And there are people now under the new tax law that want to be a C corporation because it's a flat 21% tax rate. So if you're in a 37% tax rate, if you're in a pass-through, because you're taxed on your personal income, income, you might want to be taxed at a 21% rate as a corporation. Well, an LLC can accomplish any of those. So make sure you understand that. This is where, when you talk about education, financial education, this is a very important point, because I hear all the time, oh, well, I'm going to be an LLC and I'm going to get taxed this way. Well, no, an LLC doesn't tell me how you're going to be taxed. What tells me how you're going to be taxed is, are you going to be an LLC taxed as an S corporation, a C corporation, a partnership, or a sole proprietorship?
Thank you. It is really the cooperation between an accountant and an attorney, right, Tom?
Well, that's exactly what we do. Whenever you have a new investment, okay, then you just call me. I talk to Garrett. We make sure that it's set up in the proper thing that's going to get you the best tax advantages and the best legal protection.
Next question, Melissa.
Our next question comes from Judy in Dallas, Texas. Favorite book, Rich Dad, Poor Dad. She says, I have 4 rental houses plus my home and some raw land. Under the new Trump tax laws, can I still write off the property tax?
Yeah, this is an important part, actually, of the new law.
There's something about state and local taxes and property taxes.
Right. So if you, okay, this is what you always talk about, Robert. I've heard you so many times talk about, if you're generous, you get tax breaks, and if you're not generous, you don't. Right. This is a really good example of that. If you're not generous, you buy a home for yourself, okay, your property taxes may be limited under the new tax law. If you buy
deductions.
Right, your deductions for your property taxes. If you buy a home for somebody else, like the rental properties that this caller's talking about, then there's no limit on your deduction of your property taxes.
And and they're going to raise property taxes in Hawaii. My property taxes have gone up 300%.
Oh my heavens!
It was $9,000, now it's $27,000 in the Communist Republic of Hawaii. So if you're an out-of-stater, they're coming after you. So that's why I'm probably going to sell my property.
Well, and that's a really good example, though. If your property in Hawaii is rented, okay, then you get to take that $27,000 deduction. If you live in it, you don't get to take the $27,000 deduction.
Right. And that's why, ladies and gentlemen, I was talking to the architect who was building my house 20 years ago, and I asked her who she got advice from. She's an architect, A student. Well, my brother-in-law. I said, what is your brother-in-law? Well, he's a financial planner. So he does all of her tax and legal work. I looked at her like she had holes in her head. She says, but he's my brother-in-law. She's my sister's husband. And she got all indignant. And I go, he might be a good guy, but he's not a tax attorney and he's not a CPA. So please listen, you guys. This tax law by President Trump is a gift that keeps giving for the next to 2025. And all over the world, I'm just talking to a lot of people in the world, it's the same thing, right, Tom?
Oh, absolutely. And it's a very good example of, as you talk about investing being a team sport.
Right.
Right. You have an attorney for asset protection. You might have an estate planning attorney. You have a CPA who handles taxes. You have a banker. You have a real estate person. And what happens is when they work together, okay, which very few of them do, but when they work together, then you get the asset protection, you get your legal stuff handled, and you get the best tax results. And if you want a financial planner because you want to turn your money over to somebody to manage for you, that's fine. Don't expect them to understand taxes.
And what Tom just talked about here is that they have to work together. It's one of the biggest disasters I've seen. Oh, I have an accountant, and I have an attorney, I have a bookkeeper, and they all hate each other. Going, well, who are you then? I mean, are you such a lightweight that you cannot get your team to work together? And that's why this architect I was talking to, a real smart young lady, but she says, well, I just trust my brother-in-law. I said, well, what did he do? He says, well, he took a 7-week financial planning course. I mean, how can such a smart person be so stupid, so ignorant? But they don't teach this stuff. Exactly as Ed McCaffery says, they don't teach this stuff. Look, it's a team sport. It starts with a bookkeeper, right, Tom?
It absolutely starts with a bookkeeper. You
and
have to have good records.
At minimum, a CPA. At minimum, an attorney, asset protection. And I like what Ed McCaffery was talking about. Look at a dynasty trust, because most people will die broke. Isn't it true that most people, their wealth is gone the last 2 years of their life?
Oh, absolutely. Their medical expenses just eat up all their wealth.
Yeah. And that's because they went to school and got a job, worked hard, saved money. And they really don't look into the future very long.
Well, and the reality is the Dynasty Trust actually can protect your assets from the doctors and the hospitals.
So, ladies and gentlemen, that's what the Rich Dad Radio Show is for. Once again, I thank Tom Wheelwright and Ed McCaffery. You can submit your questions to AskRobert@richdadradio.com. And this is a very good time to be rich, but not if you think like a poor person, like my poor dad. go to school, get your master's degree, get a job, work hard, save money, get out of debt, buy a house, and invest for the long term in the stock market. If you're doing that, you have a poor person's mentality. So that's why we thank you for listening to Rich Dad Radio, and thank you, Tom.